Here is a company with 82% gross margins, free cash flow above 50% of revenue, and 60% growth guidance for next year. By almost every operational measure, it is among the best-run software businesses in public markets right now. And it might be one of the riskiest things you can put money into at today's price. Both of those things are true at the same time. That tension is what this video is actually about. Because most people who have a strong opinion on Palantir are only holding one half of that picture. The bulls look at the business and say the valuation follows from the quality. The bears look at the multiples and stop reading. Neither side is doing the harder work, which is holding both things simultaneously and figuring out what they mean together. That is what we are going to do here. Palantir builds software that turns data into decisions. Not in the vague way that phrase gets used in every enterprise pitch deck, in a specific, structural way. The government platform, Gotham, was built to handle intelligence and defense work. Environments where the data is classified, the stakes are real, and the margin for error is zero. The commercial platform, Foundry, does the same thing for large organizations that have years of operational data sitting in incompatible systems that no one can actually query in a useful way. AIP, the AI layer they have been building on top of both, is the current growth story. An attempt to make Palantir the infrastructure layer through which large organizations deploy AI, not just a tool they use occasionally. What makes the product structurally interesting is not the AI branding. It is the ontology layer underneath it. Palantir does not just move data around. It maps the relationships between data, between entities, decisions, outcomes. Once an organization builds its operational logic on top of that structure, it does not leave. The switching cost is not an annual contract renewal. It is years of institutional knowledge embedded in the platform. That is real lock-in. And it is not easy to replicate. The government moat deserves its own sentence. Security clearances are not a feature. No competitor can buy them, build them in a quarter, or acquire them by poaching engineers. They take years to accumulate, and they are specific to the work. That part of the business sits behind a door that is genuinely hard to open from the outside. The numbers confirm what the product logic suggests. Palantir generated $4.475 billion in revenue in 2025, up 56% from the year before. In the fourth quarter alone, growth hit 70% year over year. The U.S. commercial segment, the non-government side, grew 109% for the full year and 137% in Q4. At a company already past $4 billion in annual revenue, that acceleration at that scale is not common. The quality metrics are cleaner than almost anything else you will find in enterprise software. Gross margin at 82.4%, operating margin around 32%, up from single digits just a few years ago. Net margin above 36%. Net income of $1.625 billion. Operating cash flow of $2.13 billion, free cash flow over $2.27 billion. The balance sheet holds $7.2 billion in cash and short-term treasuries against $230 million in debt. Current ratio above 7 times. The Rule of 40 score, growth rate plus profit margin, came in at 127% in Q4. Most mature software companies work hard to stay above 40%. For 2026, management guided roughly $7.19 billion in revenue. That is 61% growth. Not a deceleration, an acceleration. So here is a genuine question, and I want you to actually think about it before moving on. If someone described those numbers to you without telling you the company, what price-to-sales multiple would you put on it? What would feel reasonable for a business compounding at that rate with those margins and that balance sheet? Hold that number, because here is what the market has actually priced in. At roughly $153 per share, Palantir's market cap sits above $350 billion. Forward price to sales is somewhere between 60 and 80 times, depending on which growth estimate you use. Trailing EV to EBITDA is well above 200 times. Conservative discounted cash flow models, the kind that actually require you to justify your assumptions, put fair value somewhere between $20 and $60 per share. That probably sounds absurd given everything in the previous section, but the math is not complicated. At 60 times forward sales, the market is not paying for what Palantir earns today or next year. It is paying for a very specific version of the next decade, one where growth stays elevated, margins keep expanding, competition stays manageable, and nothing unexpected slows the curve. Every one of those conditions has to hold. Not most of them, all of them. Run through the scenarios honestly. The bull case. AIP becomes the standard infrastructure layer for enterprise AI. Commercial growth sustains above 40% for 3 or more years. The multiple holds as earnings catch up to it. In that scenario, this stock compounds from here. In the base case, growth is excellent but gradually normalizes toward 30 to 35%. Margins expand steadily. You get solid long-term returns, but not the explosive upside the current price implies. In the bear case, a single quarter where growth slows meaningfully or margins disappoint triggers a multiple compression. The business does not break. It just grows at 15 or 20% instead of 60, and the stock loses half its value. That last scenario is worth sitting with, because it is not a disaster scenario. It is just a business performing at a level most companies would be proud of. The problem is not the business. The problem is the price paid for it. One more data point that belongs in this section. CEO Alex Karp and co-founder Peter Thiel have been consistent sellers of Palantir stock. These are planned sales, largely structured around tax obligations on stock compensation, not panic. But the people who know this company's internals better than anyone have not been buyers at these prices. You can weight that however you want. It is still a fact worth knowing. Second question, and this one is more personal. Does it change your read on a stock when the people running it are net sellers? Not your conclusion necessarily, but your process. There is no clean answer, but it is the right thing to ask yourself before you decide it does not matter. The external environment around Palantir is, right now, about as favorable as it gets. The U.S. economy is in a soft landing. GDP growth projected around 2 to 2.5% for 2026, unemployment near 4.3%, inflation cooling toward the Fed's target, yield curve modestly positive. For growth stocks, that is a comfortable backdrop. Interest rates that are not rising, inflation that is not accelerating, a labor market that is holding. Palantir also earns the overwhelming majority of its revenue in the United States, so foreign currency volatility barely touches them. The political environment is more directly useful than any of that. The current administration has made defense spending, intelligence capability, and border technology explicit priorities. Palantir's government work sits at the intersection of all three. These are not favorable tailwinds in a general sector sense. They are contract-level opportunities that Palantir is specifically positioned for. Geopolitical instability, wherever it occurs, tends to increase demand for the tools Palantir sells to governments. That is the honest version of the statement. But here is the thing to hold alongside that. Government revenue is still 54% of the business, and government priorities are tied to political environments that change. The commercial acceleration is real, and it matters precisely because it represents Palantir diversifying away from that concentration. But it has not happened yet in a way that makes the government exposure irrelevant. Third question, and this one is worth genuinely thinking through as a scenario. If U.S. government tech priorities shifted, different administration, different budget pressures, different foreign policy posture, How far along would the commercial side need to be to carry the company through that period without a serious revenue hit? The answer to that question tells you how much political risk you are actually carrying when you hold this stock. Here is how to think about whether PLTR belongs in your portfolio, honestly framed. The question is not whether Palantir is a good company. It is one of the better-run companies in public markets. The question is whether the growth trajectory that justifies today's price actually materializes. And that comes down to what you believe about two things: the durability of the commercial acceleration and how long the government tailwind holds at this level. If you believe both hold for 3 or more years, and that AIP scales into something genuinely central to how large organizations deploy AI, the bull case is real, and the stock can go higher from here. If you are less certain, if you think commercial growth will be excellent but normalizing, and government contracts will remain solid but not accelerating, the base case gives you decent long-term returns, but at a level of risk that requires careful position sizing. The practical implication of all of this: for a stock priced at this multiple, how you enter matters more than almost any other decision. Dollar cost averaging over time reduces your exposure to the one scenario where the business is fine, but the multiple contracts sharply because of a single disappointing quarter. Waiting for a 20 to 30% pullback on normal market weakness accomplishes the same thing. Neither approach means missing the story. It means not being forced out of a long-term position by short-term volatility at a price where there is no margin of safety. Palantir pays no dividend and has not launched a share buyback program. Every dollar of free cash flow is pointed at growth. For investors who believe in that growth story, that is the right capital allocation decision. For investors who need a floor under the downside, it means the stock does its full movement in both directions without a cushion underneath it. Here is the short version of everything above. Palantir is a real business generating real profits at scale, growing faster than almost anything comparable, with a product that is genuinely hard to replicate. It is also priced for a version of the future where almost nothing goes wrong. Those two things coexist, and how you weigh them against each other is the entire investment question. The quality is not in doubt. The price is where the uncertainty lives. This video is for educational purposes only and does not constitute financial advice. Everything here reflects publicly available information and one analytical perspective, not a recommendation to buy, sell, or hold any security. Your investment decisions are your own responsibility, and you should do your own research before putting money anywhere.